Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is commercial real estate expert Mike Sowers. Now, Mike is the founder and CEO of Commercial Investors Group, whose core business is repositioning commercial real estate assets across the country. In addition to his real estate endeavors, Mike is the author of the #1 Amazon bestselling book, Commercial Real Estate Investing, a step-by-step guide to finding and funding your first deal. And he's also the host of the Creative Commercial Real Estate Podcast. And so with that, guys, it's my honor to welcome Mike Sowers to the show. Mike, how you doing, buddy?
Hey, I'm doing fantastic. Thanks for having me on.
Yeah, excited to have you here. We've had many challenges over the last couple of months of rescheduling on each other, but we're here now, so hopefully it's going to be a kick-ass show. So just excited to dive into your background and learn a little bit more about you, your business, and everything related to it, and also how you got into real estate, right? Like we're going to tell the whole story today. So maybe to start off, Mike, for those that aren't familiar with you, don't know anything about you, your background, maybe start there and let us know what you do and also how you found your way into real estate.
Sure. Currently, I'm the CEO of Commercial Investors Group, and we are an investor that buys assets of any type. We only do value add real estate deals in the Minneapolis, St. Paul market locally, and then we are franchising into other major markets right now. So we actually just launched our franchise initiative, which is pretty cool. We're the only commercial real estate investing franchise system on planet Earth, with the exception of there's a couple other companies that specialize in residential that allow their franchisees to do commercial, but they don't specialize in commercial. You can probably think of the big one, Homevestors. Yeah. That's kind of our biggest competitor on the residential side.
Okay, so like the we buy houses of commercial, solely based on commercial real estate. Interesting.
Yep, that's exactly what it is. And how I got into this is I went to school for business, finance, and entrepreneurship. I'm a recovering spreadsheet addict, and I love analyzing stuff, but I also love the sales and entrepreneurial side of things. So in college, I ran a franchise for College Pro Painters. That was actually a franchise system as well. That's where I kind of got introduced to the concept of a franchise system. And then after college, I kind of did a spin-off of that. I started a company called College Exteriors, and we started doing roofing and siding. And then I realized that there was a whole nother game out there of insurance restoration and hail damage restoration. So hailstorms would come through town, and we would go through with canvassing teams and telemarketing teams and sales reps and project managers, and we'd do hundreds of roofs. And the insurance companies would pay for all of it except for the deductible. So it was a really good gig. I built that business up to 54 people. Then I scaled back down. I did not like managing that large of a business. And eventually I exited out of that. So I was contractor by day, if you will, and house flipper and landlord by night. I was always doing residential, and I always thought about getting into commercial someday when I had saved up enough money. Right. I subscribe to that notion of when I finally have enough cash, then I'll make the transition. But I always thought that I needed to develop connections before I got into commercial. And it's like what you don't understand, you fear, and what you fear, you tend to position in your mind as something that you either can't do or that you can do someday in the future instead of taking action on it now. Well, after I exited out of my construction company, it did two things for me. It allowed me to think that I had enough cash to finally get into commercial. And it also allowed me the time to start working through some of the knowledge gaps that I have that were creating those fears of getting into the space. And so I started talking to people, and to my dismay, people were a little more holding their playbook to their chest than I would have liked, especially in the commercial real estate realm here locally, at least. So that's actually why I started my podcast, Kevin. I started my podcast to give people a reason to finally open up, because when you call somebody and are like, hey man, I want to pick your brain over coffee, it's kind of a one-sided transaction, yes. Right? But if I'm like, hey man, you want to come on my podcast and talk about whatever you're selling, or at least build your brand or whatever, now it's a two-way street. And once I got them on the show, then I could really extract whatever I wanted from them. And so I started buying properties, and I was always kind of a systems guy. I think that's why I was able to sell a small construction company in the first place, I developed a little software component that I think made it a saleable company. Otherwise, it probably wouldn't have been. And so I was like, well, how's the software look in the commercial industry? And I realized it kind of sucked. There were softwares that did like one thing really well, like Argus, for example, to analyze deals, or Appfolio Property Manager for asset management, or Yardi. And then there was, some other things for like marketing, like HubSpot or Active Campaign for email marketing. And then there would be like text messaging platforms, or like Sly Broadcast for ringless voicemails. And then you would have like Click to Mail and different things for like direct mailers. And all that stuff's great. The problem is the data was, in multiple platforms. I think one day I had 13 tabs open in my Chrome browser. The left arm's not talking to the right arm. And I'm like, there's got to be an end-to-end solution. I found a couple that were pretty close and they were nice, but they were kind of set up for residential, and the backend database was really just a glorified spreadsheet. And what I mean by that is the fields didn't allow like many-to-many relationships or one-to-many relationships like a true database would. And for our industry, that's problematic because you might have one property that has 4 owners, or you might have one owner that owns 8 properties. And so I would have all these multiple instances of the same data within my data sets when I just used a spreadsheet style database. And I really wanted to have one contact and one property, and then do relationships between them like a true like Microsoft Access would do. And so I found a platform that I could actually build all my custom apps and fields, and it allowed me to do that fairly easily. But then it also allowed third-party scripts. And so we customized the front end API and interface, and then we did all the back end APIs for direct mail, text, ringless voicemail, text messaging, different funding apps, all kinds of really cool stuff on the back end, so that it just integrated all of the stuff together. And now we have a very streamlined thing. And that actually has been what gets people the most excited about buying a franchise of our company, is getting access to that. And we plug in all their data and stuff. And I mean, it takes months and months and months to go get all the property data, get it skip traced properly, get it all set up, get it loaded into all these different systems, and schedule and launch and design all these multi-sequence direct marketing programs. And then you got all that on top of everything else you're having to do to run your business. Right. So we really try and solve the data piece for people. We really try and streamline the process. And then we solve the funding piece. I actually wanted to say thank you. After you came on my show, I really got to thinking about open-ended funds. And we just launched our first open-ended fund. We did a 506C. And dude, it's kicking ass. And I'm really having fun doing that. And it's taken off. And I found a way to partner with some other people who have large money networks to kind of bring them in as partners. And I really think that as we scale up our franchise operation, we just sold our first 2, and we have about 15 more people in the pipeline that are interested right now. And so it's going pretty well from that standpoint. And one of the things I'm saying is, hey, it's not offered to you under the franchise or agreement, but we have this sister company that provides equity funding. And so if I can build this fund in conjunction with the franchise operation, they're kind of this symbiotic relationship where there's deal flow and there's money.
Yeah, no, I love every bit. I could definitely see the relation, the affiliate relationship between the two, and how they could, bring value to both sides of the equation. So, but before we dive deeper in that, I want to back up a little bit. I want to kind of set the foundation for what you built everything on, right? And that really is that the first commercial deal, the first couple commercial deals. But let's start with the very first one, when you finally made the mental and the physical leap of faith, right, to actually dive in and buy your first value add property. I know that you're somewhat asset type agnostic. I mean, it's whatever makes sense, whether it be office, retail, industrial, you name it. As long as it's a commercial, commercial real estate, then you guys are open minded to it. And so let's talk about the first one. What type of what was it? What type of asset was it? And then ultimately, what was the value add component? And then what was the business plan to execute to extract that value?
Sure. Yeah, that's great. For us, our value adds normally a renovation and a lease up, and then usually some kind of repositioning of the leases or the financial structure, like how the vendors are set up or that kind of thing. So that's the fix, fill, and financial steps in my book. So my first asset is actually the case study I used in my book. It's the Center Drive property. I did a joint venture with another gentleman who was somewhat a mentor to me when I got into the industry. I had cash, he had experience. We did a deal together. And this property was 100% occupied and was listed at $800,000 by a residential real estate agent. I actually get a fair amount of deals that are listed by residential real estate agents that are moonlighting in commercial because for whatever reason, they tend to have a tougher time valuing properties and doing the correct marketing. And here's the other caveat. They tend to only list it on the MLS. And so it tends to not go on LoopNet or these other places, CoStar and stuff like that, or the local commercial brokerage exchange, where we do find some other deals, but usually they're really well picked over. So definitely check out the MLS because you can find some rare gems in there.
Are there any, before you move on, there used to be a few, or at least one aggregate website that allowed, because unless you have access to your local MLS, unless you're an agent or have a relationship with an agent, then you're not going to have access to that commercial MLS. But are there any aggregate sites out there that you're aware of that allow, the common folk that is not a licensed agent to gain access to, a nationwide commercial MLS database?
Nationwide, I'm not sure, to be honest with you, but I know you could look into that. I would think so it's IDX Exchange is the back end protocol that the MLSs use. And most real estate brokerages have an IDX Exchange like iFrame on their website where you can do all that. And you just check a box that you're looking for commercial properties.
Gotcha. Okay. But not, so it'd be very market specific, but not necessarily nationwide. I can't recall the name of the website. There used to be one. It was owned by LoopNet. And then anyway, the user interface got worse and worse over time. And then they just took the website down. So I'm not sure exactly what happened after that point. But anyway, I found many. The reason why I asked that is I found there's a number of opportunities I still own today that I found through that avenue, by mostly a residential agent, happening across a commercial opportunity, probably due to a relationship. Maybe he sold some houses for the family that happens to own this commercial property. They list it wrong. Sometimes it could be listed too high, right? Like they evaluate it too high. Every once in a while you get lucky, they value it too low. And I can think in my mind of one mobile home park we still own today that we bought for $1.6 million, and it got appraised 2 years ago for roughly $4.8 million. It's probably worth $5.5 million today, right? And most of that was due to the inexperience of that agent. Good agent, but just not experienced enough to value that particular asset, and he didn't get it to the masses, right? It didn't get pushed out there to the masses like a LoopNet or a Crexy might do. So anyway. Right. Not to steal your thunder, bud, but I just wanted to ask and see if you knew of any other resource out there that.
No, that's great. Actually, let me know if anybody pings you on that, because as we expand into other markets, because I think each market kind of has its own MLS. So I'm curious if there's a site that's feeding all that to one where they're compiling it all.
Yeah. So anyway, that's out there. If you're listening, if you know of that resource, if there is one, shoot me an email, kevin@kevinbupp.com, and I'll be sure to share that on the next show. So if you know of that, let me know.
I'll give you a free audiobook if you send it to me too.
Well, I'll share it with you, my friend.
So as far as the first deal, it was a multi-tenant small bay industrial building. It's kind of the mullet of real estate, I like to call it. It was all business in the front and party in the rear. And so it had drive-in doors in the back. It was messed up for a variety of reasons. One, the leases were written by the guy who had owned it for 40 years, kind of this old timer, and managed it himself and really didn't know how to market it effectively, right? He just wasn't a technology guy. He had the thing basically free and clear. It's cash flowing for him. Why mess with a good thing, right? That's kind of the attitude. You don't want to mess with a good thing. You don't want to increase rent and lose some tenants. Why would you want to do that? For example, he had one of his buddies in a 3,000 square foot, beautiful little bay, nice drive-in door. He was doing automotive type stuff, paying $897 a month. Market is like $2,250 on that. So
Wow.
we went in and we interviewed all the tenants, and we figured out that some of the tenants wanted out, some of the tenants wanted more space. And I just found some opportunities to create value for people by moving them around. And we remodeled the building slightly by solving some big problems like a roof problem, replaced one section of roof. And then the other thing that we did is walls had moved a lot over the years. And what happened was all of the units were actually separately metered. In fact, one of the huge hidden values of this property was the fact that it looked like a strip mall in the front, but it was actually an industrial zone building. And each bay was its own parcel, which means I could sell them off to a small business owner at a massive premium per square foot.
Yep.
And each one had its own utility meters, but because the lines had been moved between bays and stuff, you'd have this guy's utility meter running the bay next door or vice versa. And because of that, the owner felt uncomfortable billing the utilities back. I find utilities and maintenance vendors tend to be the two biggest areas that I can shave on operating costs, and then challenging the property taxes if they're out of line is another good way as well. But the utilities just always seem on every deal. It seems like almost every deal that I do, there's a huge improvement in the utilities realm. Either they're supposed to be getting billed back, which was the case here. The lease said he could bill back the utilities. He just never took the time to do it. And so I inherited those. And so it's some tough conversations with people like, well, the old guy never billed the utilities. You know, he was a great guy. Like, why are you being such a jackal? Right. And it's like, well, I hate to tell you that he did you this solid, but you know, I'll tell you what, let's rewrite your lease. What do you want? Do you need a remodel or whatever? And let's try and work together. Like, we're not coming in here trying to shake the sheets on anybody. We want to provide value to you first and not extract value from you. And when we went in, you know, I did some things wrong, and I learned a lot of lessons in terms of those tenant relationships that I know now. It was a lot about like the numbers initially for me, and I didn't have the right mindset about putting the tenant first necessarily. And so some of those bridges, you know, got lit on fire a little bit, but I figured out quickly, and my partner helped me solve some of the problems. He ended up wanting out of the deal pretty quick. He had a lot of other things going on. And I figured out really quickly our operational partnership just wasn't going to happen. I was doing all the work anyway. And so I came to an agreement with him to just give him 20 grand to go away on the deal. And so that's what we did. It became my deal and my deal alone. I took the leases from like a $5.25 a square foot net or gross rent rate up to like $8.25. We set everybody back on their own utilities to pay directly. And we took the NOI from about 40,000 up to 100,000. I bought the property for 700 grand, and it's worth about 1.3 to 1.4 right now. And I probably have about 50 to 100 grand into it.
Wow, that's great. And so you still own that property today, correct?
Yep.
Okay, fantastic. And have you done a refinance to pull
Yep.
some of your equity out? So
So I refied it and pulled out 750, got all my cash back out. We did some of the renovations with operating cash flow instead of taking a distribution so that my owner contributions didn't have to increase. And then think cash flow is like 50 grand a year. I got no cash in it. It's one of my favorite properties.
Yeah, no, that's fantastic. And when was that? How many years back was that? And
that was March of 2018. I bought that.
Okay, good deal. And so, yeah, my question for you. So that was a, you know, what you classify that as industrial, right? I mean, is that flex space industrial?
Yep.
I know that you're asset type agnostic, and you know, for me, I've always done really well with focusing on, you know, one or two asset types. Typically, it's one. You know, we just expanded kind of our reach to another asset type, but only after, you know, 9 or 10 years of staying laser focused on. And this is active investing. So I've got, you know, many different passive investments and, you know, self-storage, industrial, medical office, things of that nature. It's just it's really hard to be you know, to be the expert at everything. They've got similarities, but they've also got equal amounts of differences and unique nuances associated.
They're like
with them.
siblings.
So, yeah. So I guess my question for you is how, you know, you've done other asset types. Again, you're a value add guy. Again, asset type agnostic. How do you how do you find the necessary expertise or de-risk a particular investment when it's very different from that? So let's talk about maybe the second deal or whatever the deal was that wasn't an industrial deal. So you went from an industrial property to what was like the next big shift? Was it office? Was it retail? Was it multifamily? And how do you quickly get up to speed with that different type of deal?
Sure. So there's a couple of points you're making here that are really good points, which is how do you maintain expert level understanding of the assets you're buying when you're buying these different types of assets? I think
Sure.
that's what you're asking me.
Yeah, absolutely. Absolutely.
And my question to that, first off, is I would consider I would really say there's kind of two types of properties. There's properties where they're true real estate operations. And then there's properties where it's kind of like there's a business embedded within the real estate operation. In some ways, I look at like mobile home parks and I look at like self-storage and those types of niches where you're actually buying a business and a piece of real estate. And so there it is particularly important that you specialize, because running a business within the real estate operation is so critical, because you have to understand all the marketing pieces and all the other stuff that doesn't really go into just a traditional real estate play. So that's my first thing, is I never got into niches that required me to move from being a landlord into being a business owner. The second thing is I do kind of specialize in a couple of different niches within. So I say I'm agnostic, but I won't buy for a long-term hold on, say, like a single tenant retail. Okay. So if that opportunity comes across my plate, I'll analyze what's it worth today. Can I make a spread? It's more of a, turn and burn. Can I get it under contract at X? We just bought 3 office condos, $250 a piece. We just got a cash offer on one of them for $400. I think he's low on it. I think we can probably squeeze 150, 175 out of each of those condos. I don't love office condos as a long-term play. So I'm answering your question in a roundabout way, is I have taken the time to become an expert in the areas of properties that we do buy, which is small bay, warehouse type projects. I would say we definitely have a high level of expertise in that area. The other thing would be like suburban Class B and Class C office. We have a really high level of expertise in that area. And then apartments, like mid-cap apartments, like anywhere from 10 to 100 units is kind of our sweet spot. I would love to get involved either as a passive or as one of the general partners on some larger stuff. I just have been focusing on the niches of office and industrial primarily because I find there to be a significant reduced number of competitors in that area. There's a lot of people competing and marketing for the apartment stuff. And I've just been able to find a lot more local opportunities within the office and small bay warehouse niches. And so it kind of creates this, there's the perceived risk that the market has of these assets. And then there's the real risk, and the risk comes in many different ways. And you talked about how do you mitigate that risk? We mitigate the long-term risk of being overextended on a project by only doing value add stuff and making sure we're buying at the right price and then creating significant value in the property. So we have a big equity cushion. So really strategy solves our long-term risk. The short-term risk is our system and making sure that I have the right people and the right knowledge in each of those asset classes. So, I think that suburban office and warehouse are so similar that they're not that dissimilar. Gotcha. Really, the outliers, like apartments, tend to be significantly different than office retail because they're like valued based on the number of bedrooms in terms of the rent you can get versus like a rent per square foot. So just trying to kind of stay within my little niches. I do think that that it is important to have a niche. And so when I say I'm asset class agnostic, I mean, I'll buy multiple asset classes, but I still have kind of niches within those that I really like. And if I stray outside of that niche, it's more of a speculative, can I just buy it and flip it quick for $1 type thing.
Has COVID shifted your interest level at all in the suburban office space?
It increased it dramatically.
Really?
Yeah, because
expand on that.
Dude, all right. So dude, check this out. suburban office, like the office I'm standing in right now, we bought for $770,000. Okay. And we sold it for 1.1 million. I think I put 80 grand into it.
Did you buy it during COVID?
No, that was pre-COVID. Now
Okay.
COVID hit, and here's what everybody saw. They saw the downtown evacuation, and they saw large tenants when they either defaulted or went to renew, drastically downsizing their spaces. You know what people aren't talking about on the news is the fact that the small entrepreneur who started working from home and his cat's walking across his keyboard, his kids are crying, has no privacy. You know, the small entrepreneurial lady who owns a business and she has 2 employees and now they're coming to her house and it's super awkward. These are the reasons why people want 1 or 2 offices inside of a small little office park so they can just feel like they're getting out of the house and doing something. It motivates you to take a shower and take off your sweatpants in the morning because you know you're going to go in and see at least a couple of people. And so we found this niche to buy these 15 to 100,000 square foot suburban offices that'll have 30, 50, 75 small tenants at 500 square feet to 2,500 square feet.
Mm-hmm.
And it may sound like a management nightmare. It is a lot. It's very management intensive, but we hire a really good management operator who's really detail oriented. And then we have an absolute world-class marketing strategy. And we're just slinging leases left and right on these small offices when everybody else like office is dead, office is declining. I'm like, great, because I'm buying properties for $50 a square foot that rent for a net rent rate of like $8 to $10 a square foot.
Yeah.
And so I'm getting these absurd cap rates on these properties, and your apartment building that looks super pretty and your break even cash flow is like, 87% occupancy or something. I got an office building we bought at 40% occupancy. It covers its debt service and pays me $5,000 a month. And then when I fill it to 85% occupancy, it pays me $30,000 a month.
Yeah.
That's why I love the opportunity.
Did you buy that during COVID? Was that
Yes.
a COVID discounted property?
Okay.
Speaking to that, are you seeing, have you seen any type of distress in the office space in your immediate marketplace as a result of COVID? Have you seen a price reduction? Have you seen a motivation, a higher motivation from office property owners, as a result of COVID than what you did prior to COVID? I mean, are there more opportunities flooding your marketplace?
Yeah. So I think the key here is looking at it and figuring out how am I capitalizing on it instead of letting it create fear within me to basically not do anything. So how do I take the data and the understanding of what's happening in the market and use it to my advantage? How do I actually take action on it instead of creating inaction? And so the action we're taking is we're targeting like professionals, law firms, accountants, things that companies that would have traditionally been in the downtown arena.
Mm-hmm.
And we believe that would be downsizing significantly and the perfect fits for a multi-tenant stuff. And we have bots that create prospecting lists by scraping Yelp and Google Places. And then we use our campaign manager to get our listings in front of them with a unique message. We're also, our rates have not changed, but what we do is we give really good concessions. So I'll give like 3 months free rent. I'll cover your moving costs. We'll do whatever it takes to get you into our space. And because we're small enough and nimble enough, and we got a really aggressive team over here, with our sense of urgency, we can get deals done, and our processes are streamlined. If you come out to show one of our properties, we can have a lease signed with you by 5 p.m. that day. And that's way different than some of these other large companies where it's going to an attorney and there's this redlining and all this. It's like, dude, that's not the niche we're going after. So there is an exodus coming out of corporate office sectors, but they're moving to the types of properties we're targeting. So we're changing our strategy of making sure we're only buying multi-tenant properties that have small spaces.
Got it. How about finding opportunity? I know that you just kind of mentioned a little bit of what you do. We talked about brokers that aren't necessarily commercial brokers that, mislist or misrepresent in a good way, properties for sale. But I mean, what's kind of the strategy that works the best for you guys on uncovering opportunities. What is that strategy going to look like for the rest of the franchise? Is it direct mail, cold calling, these brokers, or is, just what's like the best way that you guys have been able to uncover great opportunities? Again, you guys are in a competitive area. I mean, St. Paul, Minneapolis. I mean, there's plenty of other real estate investors. I know you're somewhat of a contrarian going after office, but there's still others like you that are out there looking for those value add opportunities, looking for any of the pain in the marketplace. And so again, how do you set yourselves apart and find those hidden gems or those needles in the haystack? Like, what's the number one way of doing that?
Sure. I'd say two things: leveraging technology and leveraging relationships.
Okay.
That's really what it comes down to. The primary thing is the broker relationships.
Yeah.
Trying to utilize that. But to be honest with you, if you're just getting started, it's hard to convince a broker who's a seasoned broker to bring you any kind of deals, because look, they know when they see a deal and they're going to bring it to their buddies, or maybe even put together a group and take it down themselves. So if you're getting started, don't just rely on brokers, because you're putting your results in somebody else's hands and you're being reactive. So I say for people starting off, you got to just pound the phones, man. It's calling property owners directly. And then when they don't want to sell you a property, you're like, well, why not? Is it cash flowing great? And they're like, yeah, it's cash flowing great. And it's like, well, great. Let me tell you about our fund that we're using to buy all these off market opportunities, and I'll convert them to an investor. Before I would just put them on a list, but now I have this open-ended fund.
Yep.
Great idea to send them to. So that's that piece. But yeah, man, it's you don't need a million different things, the social medias and all that. We do all that, but honestly, the vast majority of our deals come from a broker called us up. Hey man, I got this deal coming up, or somebody responded to a phone call or an email or a flyer I sent out to them or something like that.
How about the importance of banking relationships? And that comes to mind. That question comes to mind given your focus on office. Again, a lot of folks, including lenders, kind of follow the trends, and the typical lender would probably be shying away at this point in time from office and from retail. Maybe not entirely, but just if they had trepidation towards any asset classes, it's going to be those two, right? And probably hospitality. Those three, really. Hospitality with being priority number one to be cautious of. And so I'm assuming that the lenders that you've used are established relationships, banks and lenders that you've done business with historically. And so talk to me about how that relationship, that established rapport benefits someone like you that's buying an asset class that might not be as attractive as the the sexy multifamilies of the world, and why someone needs to really start establishing those lending relationships today, because ultimately it's going to pay dividends well into the future.
Yeah. Well, that's a lot all rolled into one question.
It is. It's all about the importance of banking relationships. And,
sure.
So how that's benefited you, and also just some advice, if you would, to those that are listening that might just be getting started in their commercial real estate ventures.
Yeah, absolutely. So I think I can handle that by talking about the second deal that I did that you asked about earlier. That was a historic renovation of a mixed-use building built in 1888. We did a $3.5 million renovation. I was the GC on the project. We had, I think, like 50 subs, and it was a completely different project than my first little multi-bay warehouse. It drug on for 3 years. We got tax credits. I learned that whole process. And quite frankly, I think that's when I first started getting gray hair.
And that adds some complexities for sure to the deal.
So that was by far the hardest deal I've ever done. That was a true opportunistic deal. And when I started financing that and creating relationships with bankers, I figured out very quickly that there's kind of two categories of bankers. There's your big, like, we're only lending on historical cash flow type bankers. And then there's the local credit unions and community banks that lend somewhat on the past, but they're more banking on your business plan, your character, and your ability to execute, and are willing to take a little bit more risk to win your business, but maybe their rates are a little bit, different or whatever. So I found the second to really be the type of lenders that I would look at, but I got denied by 10 banks on that deal, but I never quit. And what I did is I listened to what they were telling me. This building was an office building upstairs and then retail on the main floor. And they were all telling me that they didn't want to lend on office. And finally I caved in and decided to do a conversion to apartments. The reason I didn't want to do it is because I had to raise $2 million more and I was out of money. And that's when it forced me to figure out how to raise capital from other people. I had zero network. I had zero network of money. I had no idea how to raise capital from other people. And I stumbled across this idea of doing a crowd fund. And I thought, this is genius. If I build it, they will come. Who wouldn't want to put 25 grand into this little crowd fund and be a partner on this thing? And so I spent a couple months putting this whole crowd fund together. And I thought, hey, here's launch day. I'm going to do this webinar and I'm going to be fully subscribed. And it was crickets. Nobody wanted to give me their money. And so I learned another second lesson, that equity funding is the same as debt funding. You got to listen to what people are telling you and figure out how to change and not take things personally or quit and give up. And so I just kept pounding the phones. And finally I was like, you know what, I'm going to bite the bullet and I'm going to go to friends and family. And what I learned is that there was something inside of me. It wasn't that my friends and family didn't trust me with their money. It was that I didn't trust me with their money.
Yeah.
And once I figured out, like, okay, I'm confident in my project. I put my wife's mother, like my mother-in-law in the deal. I put my dad in the deal. I put everybody I knew, and I've raised, took me like 6 months. I raised $525,000 through this crowdfunding. It was the hardest grinding I've ever done. I finally got a lender to give me the loan. And if I didn't get the loan or all the money, I think I was going to lose like $400,000. It was going to be,
oh, wow,
this massive loss, because I had already started doing a bunch of things and spending all this money as I was going through raising all this. Now, the only reason I had that long is because I bought a junior lien while the property was in redemption. But if I didn't come up with the cash to redeem the property at the end, I basically lost all my rights.
Oh boy.
So it was a very risky deal. If I could go back, I would talk myself out of doing it from the standpoint of the risk I took for the return. But on the flip side, I learned like PhD level understanding of all of that stuff, and enough to say that's not something I want to do for the rest of my life. And that's why I went back to doing more deals like the first deal, which is more the value add, cosmetic updates. I'm not doing ground up. I'm staying in my lane. Like, we buy multi-tenant buildings, we fix them up, we use an aggressive marketing strategy to fill them, and then we put good management in place to build back things that should be built back and find good vendors. And that's really as simple as it comes down to. And then we fund them using accredited only investors now who are already accustomed to investing in this type of stuff. And it's not me trying to sell them anything. In fact, they're already sold. They just need to find you and understand your business model, and that you understand that you have a system. And that's part of why I started writing my book, is it forced me to think through my system. And I uncovered some errors as I was going through the book and being like, hey, how am I actually doing this? Or a lot of the questions you're asking me, thinking through that, like, what is the bankers looking for? Maybe I should interview some bankers and figure this out so I can actually write about it in my book. And so that was the best piece that came out of that. And I think the banking relationships are super critical. And focusing on the right types of lenders, the smaller local lenders, and then really selling them on your business plan and your ability to perform, and why that in the long term creates less risk for them, because the debt service coverage ratio after you perform your business plan oftentimes is way better than the alternative stabilized options that you have in the market.
Yeah, no, I absolutely agree with that. And, we do deals all across the country, not across the country, but we have, we're not just based here in the immediate Tampa Bay area. In fact, we do very few deals in our immediate vicinity, because buying mobile home parks, buying parking assets, which are the two assets we focus on, it's just, we'd be limited if we only focused right in our immediate backyard. And so, we're in, a couple different regions, and for the most part, we've always found it quite challenging dealing with local banks and lenders, credit unions, things of that nature, only because most of the time they want either the asset or the borrower or both in the immediate marketplace, right? They want it there because they want just more than that deal. They want a banking relationship. And so a lot of times that kills it right then and there. However, we did a deal recently here local to us in our backyard. Fairly large parking asset down in Clearwater Beach, about a $20 million deal in total. And we put this, it's an institutional grade property. So like, lots of different debt options available. We put it out to CMBS lenders, different debt funds. We basically just threw it out everywhere. And what we found, which is quite interesting, the one that wasn't on our radar was a local bank that had lent on in the past. They've lent on, they've done a lot of projects in and around the Tampa Bay area, both residential and commercial. And we just really hadn't given them much thought because we never felt like, a local bank might offer us a better deal, in overall terms and rate and what have you. And they absolutely blew everyone else out of the water. Absolutely. The terms, the rate, the ease of dealing with them, just the ease of getting the deal to the finish line was a night and day difference of what we're used to with either an agency lender or a CMBS lender or a debt fund. I mean, anyway, so I was absolutely shocked. And so proof in that there's a lot of benefit and opportunity in dealing with local lenders, local credit unions, what have you. Again, this is again, the challenges you might run into is if you're an investor and you're in Tampa, but you're trying to buy a property in Oklahoma.
Sure.
It's a little bit more challenging to build that relationship with that local lender or credit union. But if you're local to your projects, I would first and foremost, no matter what the size, you're going to find limitations with some banks and lenders on the size deals that they'll do, or how much they'll do with one particular borrower. But I would go there first. If it's in my backyard, I would go there first.
Yeah, so that actually is a good question because I'm looking to establish a relationship with the larger lenders. So what advice would you have for me as we try and develop relationships that our franchisees can leverage in other markets as we kind of move out of the local lender realm? Who's out there?
That's a great question. So, we've got a few brokers, commercial real estate brokers on the lending side that we've used, but one predominantly that we've been drawn to over the past 2 years that places a lot of debt. So like speak to mobile home parks, right? Because now this broker has lent on everything across the board, right? He's done he's placed debt for self-storage, for industrial, for office, for everything. But however, I'd say 80% of his business over the last 15 years that he's been a commercial broker has been in manufactured housing. And so he's already taken a lot of time over the 15 years of his career to build relationships with all the banks across the country, right, on a nationwide scale. That would take you and I 15 years to do. And so we basically put any deal in his hands. And so whenever we find an opportunity, we basically go right to him. We know that is the fastest path to finding the best lender. And also he gets breaks. I mean, these lenders that we might have never dealt with before, if we go to them directly, more than likely he's going to be able to negotiate probably better terms of what we'd be able to do ourselves because he's given them more business, right? They're going to treat him better, us using him as a conduit than if we went to them directly. And so to answer your question is to find a few select brokers that have a lot of lending experience or placing debt experience in the type of asset that your franchisees are focusing on. And so I don't think it's a one size fits all either. Again, we actually handed him a deal. We actually handed him that parking lot deal. Parking is the parking garage. He's done some in the past, but he didn't have the deep relationships. He just didn't have them. I'm not going to fault him for that. It just has never been a focus of his. Whereas there was a different commercial real estate broker with a different firm, Meridian Capital, based out of New York. This guy has literally placed over $1 billion in just the parking space over the past 5 years. So parking garages, surface lots, and things of that nature. That guy had way more relationships already established with lenders that like that asset class than our go-to. And so you got to find that right broker. I think that's my answer. Find that right broker. Okay,
cool. That's good feedback. Thank you.
Yeah. Because those brokers, they also work with local banks and lenders, and they know the banks that they'll know the bank. They won't waste their time with the banks that have maybe, kind of the criteria of like, well, that borrower's got to be in that local marketplace, right? And there's plenty of other local banks that don't have that requirement. They'll know which ones to go to and which ones not to go to so that they don't waste time. And they'll also be the ones that will better they'll do a better job packaging your proposal to that bank. Unless you got an in-house team to do it, they're going to take a time and energy. And I think that's where a lot of the value comes in as well, is them putting together a nice, pretty presentation and selling your opportunity to these different banks. And again, unless you've got someone in-house that's going to focus on that, because your time is probably better spent doing other things. That's where also a good broker brings value to the table.
And then, so are the banks who take placements through the broker, they kind of give up their origination and then the broker takes it?
Yeah, I
Is
guess
that kind of how it works? Or?
it's all across the board. A lot of times, so I'll give you an example. A recent deal we did, the bank still wanted 1%. Our broker normally would get 1%. However, he'll cut it down to 0.5%. Other times, the bank will just do 0.5%. Our broker will still do 0.5%. So it's total 1. And so I would go in expecting to pay 1% total origination, and it might be split between both the bank and the broker. Sure. Sometimes you might find a situation like we just found ourselves in where based on the terms we got, I wasn't even going to argue. I probably could have pushed back with the bank to cut theirs down from 1% to maybe 0.75%. Our broker had already taken his down to 0.5%, but I felt like we would probably do a lot more business with this local bank. I wasn't going to beat them up over 0.25%. Because their terms blew everyone else's out of the water. So to me, it felt it was worth 1.5 to get the deal that we got. So
cough it up. What kind of terms are we talking here?
But that's the most we've ever paid. Like that's the most we've ever paid as far as origination. Like a total combined 1.5. And so, no, I mean, it was phenomenal. I mean, it's a 10-year, 30-year amortization, 2 years interest only. Like the rate was like 3.4%.
Wow.
Yeah, I mean, it's just anyway, just a 10-year fixed on the term.
That's
and this
amazing.
is with and non-recourse. So let's get that part out, because most lenders and local banks don't do non-recourse.
No,
so
what kind of leverage points are you doing? Like 65?
60%, which is common though with parking.
Sure.
That is very common with parking, right? And so parking is typically a much lower LTV than that of a multifamily property, or maybe even some more common commercial real estate types, industrial and things of that nature. So, but no, that was it's phenomenal term. Again, it blew every other non-recourse lender, again, CMBS, and there's a number of debt funds we went to. It blew them out of the water. So,
sure. Yeah, that's great.
Anyway, yeah. So last thing here before we wrap this up, Mike, everyone talks about all the great deals, the ones that went well. You even said your second deal, it went really well, but it was really challenging. Fair enough. But like it turned out quite well for you guys. There's plenty of other deals that groups like yours, groups like ours, that we know that ultimately we pursue, we tie up, we spend some time and money on, but just don't make it to the finish line. And most of the time it's our choice to kill a deal for one reason or another. I just got back from due diligence trip yesterday on 2 parks we're buying, and I gave the thumbs up at the end of that trip. However, the prior week I went on a trip, was excited about, and I gave the thumbs down, and we walked away from a few different deals for a variety of reasons. And so my question to you would be, maybe share a recent story of a deal that you guys were excited about, you were pursuing, and ultimately you decided to back away from it for one reason or another. And then really what that reason was, like, just to give our listeners a sense of, not every deal works out. And here's some of the things you might uncover. Here's some of the skeletons that might come out during your due diligence period.
Sure. Yeah, that's great. Normally it all shakes back to the numbers. Like we project the future value, deduct the costs we're going to have to stabilize the property, deduct our minimum desired profit for the risk we're going to take. And that's our bottom line for the most we can pay for the property. So one of two things either comes up, either the risk profile changes or the numbers change. And the example I'll give you is one where both changed. We were buying a 110,000 square foot office building. I liked it. We were getting it at $70 a square foot. The underlying occupancy was good, but I think there was some meat on the bone for increasing rent rates, polishing it up a little bit. A location, everything was looking good. Then COVID hit and we reran the numbers. He lost a couple of tenants. We looked at, hey, maybe the rents are going to go down a little bit. We started seeing some erosion of the rent rates in that immediate local market. And really it was less the rent rates, more the occupancy rate. We reanalyzed the deal with the lower occupancy rate. And in doing so, we also figured out the character of the seller was such that we couldn't trust him anymore.
Yeah.
And so once I lost the trust of him, I started diving a little deeper into some other things just to kind of double check some of the assumptions or things that were being given to us. And we found out that there were some underlying issues between the tenants and them, and that a lot of the people had planned on breaking their leases or leaving after we were going to close.
Wow.
And so it was kind of the numbers, and it was the risk profile went up. And so then it just didn't work. And we ended up leaving a fair amount of money on the table. But that's just part of the game. And so it hurt, but it's going to hurt a lot more if you close on the deal.
Absolutely. It's the cost of doing business. I mean, it's just, that's it. That's one of the things with getting into this business. You have to understand there's pursuit costs, and those pursuit costs on some of these bigger deals can be, 10,000, 15, 20, sometimes even, higher than that, a lot of money. So one of the deals that we just backed away from, it was just that it was already kind of a seller that I didn't feel overly comfortable with. I knew that we were going to uncover something, but I couldn't pinpoint what it was going to be. And come to find out, it was so overtly blatant that about his numbers. We met with one of the management companies that's managing a couple of these assets, and they divulged that the financials and the reports that the seller had been giving us were not the same as what they had been giving the seller. It didn't reflect real actuals of how those properties have been performing over the past 18
modifying
months.
The spreadsheets.
So, literally, making up his own spreadsheets and giving us complete BS numbers. I mean, like about as blatantly, just I've never actually experienced that blatant of a inaccuracies from a seller as far as financials. I mean, just complete lying across the board. So
I actually got a tip. I got a tip for the listeners on that one, actually, because this is a really critical skill. Okay. So you get the pro forma on the marketing piece, and that's like, okay, that's worthless. Right. Then you get the financials from the seller. And then during our due diligence, what we'll do is we'll get the full GL from their accounting system, and then we run a pivot table on it, and then we compare that to their financials. And I did that with him, and it actually uncovered quite a few issues. And then the final step is we take the bank statements, and then I use Adobe DC to convert them back to Excel spreadsheets, and then I add up the actual income and expenses that are coming in and out of the accounts. And that's where we were like, okay, dude, you're saying you're getting 110,000 a month in income, but you're only depositing, $79,000 a month. What's the delta? And when we started asking questions like that, that's when things got uncomfortable and character issues started arising.
Yeah. Well, that was our red flag. He wouldn't share some of that information out of the gate, until we got further along. Right. And so that was the first red flag, but we knew that there was something, and ultimately, again, didn't realize it was going to be as big as what we uncovered. And it was it would have been blatantly obvious to anyone that would have done just the amount of due diligence we did. Like we were going to find it out. For him to think that we wouldn't was shocking to me, because we both wrapped up some time and energy and money and attorney's costs, like just with the contract negotiation, right? Sure. It's a $30 million deal. And so, and it just shocking that there's sellers out there like that, but you just gotta be careful. It's a big boys game, and you can win this big boys game and make a lot of money, or you can lose a lot of money. So
it's true. It's true.
In any event, Mike, this has been a lot of fun, buddy, having you in the show. We finally made it happen. So thank you for coming on and sharing all your insights and stories, and just being vulnerable a little bit as well, and just really enjoyed having you here. So for those that want to learn more about you and your business and your podcast, your book, even the franchise that you're putting together, where's the best place for them to go and find more?
Our website, commercialinvestorsgroup.com. On there, you can book a discovery call with me if you want to talk to me about anything or just get advice. You can also pick up a free copy. I give away a free PDF of my book on there. I think there's a link to the Amazon page, or just type my name into Amazon if you want to grab I like the hardcover over the soft cover personally. Thanks for having me on the show. I had a lot of fun.
Been a lot of fun, my friend. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You take care.